Hey everybody, welcome back to our On the Money YouTube channel powered by Allied Wealth. Matt Stevenson, president of Allied Wealth here. Today what I wanted to do is walk through some of the long-standing investing myths and facts that we've all heard from our next door neighbors, friends, family members, watching the news at night, and how they absolutely impact the decisions that we make in building a plan for retirement. And all of this goes back to the period from the early 1980s to the year 2000s, what we call the 401k effect. And these are the periods of time where we were moving away from having that pension, working for a company for 30 to 40 years, getting that gold watch and the retirement party, and having our guaranteed sources of income guaranteed to us to maintain our lifestyle through a pension, maybe Social Security benefit. That all changed in the late 70s and the early 80s with the advent of the 401k. And as the onus came to us to self-fund our own retirement, that's where a lot of volatility started to creep into the market, but also some excellent years for our stock market, the S&P 500. In fact, from the period from 1980 to the turn of the century in the year 2000, the market returned a nearly 1,300%. That is an astonishing number that has never been repeated before or since. And folks, that's what we call an anomaly in today's environment. Could it happen again? Potentially. Is it likely? Maybe not. Now, at the same time that our stock market was seeing unbelievable returns, the bond market also had astounding growth. Think back to the late 70s, early 80s. Maybe some of you watching this video bought your first home during that time frame. Do you remember the mortgage rate that you were paying on that? Maybe it was 12 to 15%. And what's happened since that time? Interest rates have absolutely collapsed until recently. In fact, we, over the next 40 years, reached a near zero interest rate environment. And so as interest rates collapsed, that was an awesome time to be a bond investor because there's this seesaw relationship that happens as rates decline, bond prices increase, and vice versa. So this was the advent of not only the 401k, but so many of us have heard that term, a 60-40 portfolio. I put my money in 60% stock market, 40% bond market, and maybe we tweak it a time or two each year and let that ride. That should give us the results that we need. And absolutely, for a long period of time, it did. But one of the things that we've seen is that leads us to this idea of conventional financial wisdom. And we define that as these concepts and ideas that we've heard from a variety of sources. We accept it as truth because they have worked for so long, especially when we think about these time frames with excellent returns in the stock and the bond market. But this conventional financial wisdom may no longer be applicable because we see all of this volatility, all of these concerns, inflation, interest rates, geopolitical mess going on around us that's creating more uncertainty now than ever before. Now, this conventional financial wisdom leads to some of these phrases that we've heard all the time in the past, maybe from our neighbors, maybe even our advisors that we previously worked with. And some of these will be familiar. Buy and hold is the best strategy for retirement accounts. Let's pick a few stocks and funds. We want to let that ride. The market always comes back. We can't be timing things. All right, we've all heard that. Diversification will protect you. Now, many of us have several different stocks or maybe mutual funds in our investment accounts. Does that mean that we're properly diversified if we're seeing our accounts down 20, 30%, even more in a challenging environment such as we have now? Stay invested. You can't miss the best days of the market. Don't be a fool who sells at the bottom. Well, that's actually really difficult when our emotions take hold and we want to get out of harm's way because we don't know what happens next. Tied to that, don't move to cash. The rebound is equal to the drop. It's okay to lose money. It'll always come back. The market always has. These are paper losses. That's one of my favorite ones to talk about. Well, as we'll see moving forward, it's not just a paper loss. If we're in that retirement red zone, 5 years out from or into retirement, and we need to use this nest egg to generate reliable income for many years into the future. And again, just hang in there. The market always comes back. You haven't lost any money until you sell. Folks, we've all heard at least some combination of these phrases from different sources. These are the things that stick in our mind that can sometimes derail the decisions that we make in staying on a retirement path. And there's a profound reason for this. There's a company called Dalbar, and they've been around for 30 years or so, and they do what's called a quantitative analysis of investor behavior. Now that's a mouthful, but what they're looking for is what does the average investor, just like you and I, make in returns every single year compared to the stock market, the S&P 500. Now the interesting thing is that every single year they've done the study, for nearly 30 years, they find the exact same result. It kind of sounds like the definition of insanity, right? But this is so interesting because they find that the average investor gets about 1/2 of whatever the market return is. And there's several variables that we can attribute to this. You know, the cost of the different funds we use, maybe a fee that we're paying to advisor. But all that pales in comparison to emotion. The reason why is, and especially when we see these impact events, just like 2022, an 08-09 scenario, the dot-com crash, when we see these losses compounding 30, 40, 50%, the fear and the power of realizing a loss is so much more powerful than our desire to seek gains and growth. That's just human nature. And so that's when we ask ourselves these questions. Is it time to change what I'm doing? Do I get out of the market? Do I sell to cash? All of these things that we've just talked about. And here we see the results of that. You know, if the market returns on average about 8% per year, folks are getting about half of that because of these emotional decisions that drive us. And so whether it's the financial media, local news, it's hard to get away from all this coverage. It's beaten into our heads every night as we're watching the news, whether it's fact or fiction or not. And these absolutely influence the decisions that we make. And, you know, this could be any news outlet, CNN, CNBC, Fox News, Bloomberg, there's tons of them out there. The internet, the world's smartest financial advisor, Google, of course, has the answer for everything. But there's all this information that we can search at the click of a button, and some of it can be conflicting at times. You know, maybe it's a magazine we're reading. Maybe it's something that we do read on social media. So our lovely former president there, President Donald Trump, used to be pretty active on Twitter back in the day, but as we may remember, whenever he would post something online, the market had sometimes a positive, sometimes a negative reaction to that in a very strong way. And so social media absolutely influences the behaviors and drives the market as a result. We've talked about friends and family. You know, when we have get-togethers, holiday season's fast approaching, maybe we're next to the water cooler at work talking about what's going on with this crazy market environment. It's difficult to get away from the conversation about what you're doing versus someone else. But you shouldn't compare yourself for any number of reasons. First of all, are you comfortable taking advice from a friend or family member or somebody that you work with, right? Have they shown to be successful at whatever strategy they're implementing? Now, maybe this is human nature too, but if you're talking to somebody at the water cooler, it seems like more often than not, they're having a pretty good success rate with things, right? Where it's very difficult to admit our failures at times. What sort of due diligence has been done on their part based on your needs and your situation? Probably not much, right? What are they quoting? Are they just pulling something from somebody else? Are they actually doing homework based on their needs and yours? Do they know your risk tolerance? Do they know your capacity or your ability to actually withstand losses through a major market event? Now, these are the questions that we so often overlook, but we have to ask ourselves that influence what we do with our money. And so we talk a lot about emotional decision making, and that's what we look to rein in with our clients with On the Money and Allied Wealth to create more consistency, have a rules-based approach. It's not always perfect, nor will it ever be, but it gives us a systematic process to abide by and follow to navigate extremely challenging market environments such as the one that we're seeing right now. Folks, just a little bit of content here to share with you today. If you like our content, make sure to subscribe and hit the like button below, and check us out for more content to follow.